This is the current federal tax developments for the week of March 15th, 2021. Current federal tax developments are brought to you by Kaplan Financial Education and your state Society of CPAs. I'm Ed Zollers, coming to you this week from Phoenix, where we're going to be talking about the major bill that we had signed on Thursday into law that contains provisions that affect us retroactively into 2020 in some cases, and have other provisions that are going to be impacting 21, but they're going to be doing it in a way that clients will probably be calling you right away to try to figure out how it's going to impact them and what they should or shouldn't be doing. So we'll talk about this week, as we said, a look at the American Rescue Plan Act of 2021. The acronym is either ARP or ARPA, depends upon where you look, which way it's done. So ARP or ARPA, whichever way you want to look at this bill. It includes a number of provisions we're going to talk about here briefly. I'm going to do a brief summary today. I am doing doing 2-hour courses, not really full courses, but trying to find a place that sits in the middle between giving you a complete deep dive into the provisions and leaving you some time to actually do things in tax season. So we're kind of working on a condensed in the middle version, and I'll be doing sessions on Thursday for Arizona and Idaho on this issue. I'll do a bit longer session that was already scheduled later in the following week for New Jersey, my tax update that's done on a monthly basis. That one will definitely be covering this act, and primarily that'll be the coverage there. We may talk about a few other things, but this will be the main thing covered there. But today we'll look at some of the issues like the unemployment exclusion for 2020, and yes, it's retroactive into last year. So we'll talk about what that does and what it does to already filed returns. We talk about the third recovery rebate. This one will be the 2021 version, which also means that we don't have to worry about putting out the 2020 return. Thank the world for, small favors, shall we say, that we don't have to go back and worry about putting that into 21 and reconciling 21 returns. Rather, it's going to go on to the 20 returns, I should say. It's going to go on to the 2021 return. We'll have that. We have a new prepaid child tax credit for 2021. And that means that we're going to see the tax credit increase for most taxpayers, and we're going to see the tax credit begin to be prepaid. So this starts down the path of a monthly payment of the child tax credit in advance. So we'll see how that all works out. That ought to make it interesting. We have some liberalizations to the earned income tax credit that hits a bunch of miscellaneous issues. It's kind of interesting changes there that we have. Some of them are permanent. Some of them are very short term. We also have a refundable dependent care assistance credit. We'll talk about what changes there for dependent care credit. Changes, you may find the credit increase in many cases rather substantially. You will also find that it is refundable, but there will be cases where you're going to find that taxpayers won't qualify for the credit at all in 2021 who've qualified up to now. So we'll talk about where that goes. We'll also talk about the extension of the sick pay, family leave pay credits for employers. No, it's still not required for you to offer the leave, so they didn't put that in. There had been some suggestion that we might have seen that added to the bill this time. That is not there, but they did add a couple of new categories here. And the only caveat I'm going to tell everybody is please remember these new categories do not take effect until April 1st. They do not apply the first quarter of this year. And one in particular is probably going to be a little frustrating that it doesn't apply. It kind of depends on where your state is in the vaccination program. But in any event, it is not going to apply until April 1st. So be aware of that. Don't get ahead of this one. We're also going to talk about the 2021 second half of the year revisions to the employee retention credit. Key issues there, looking at what got added. We did get one class of employers added into the employee retention credit. Otherwise, it's a lot like the old credit. So aren't a lot of changes to that, except that we get it for another 6 months. And pretty much everybody that gets it now, in fact, I think it's absolutely true. Everybody that would qualify now will qualify then, as long as they have a distress period in the second half of the year. That'll be key. And we also have some significant changes to the premium tax credit. one of which will impact 2020 returns, and of course will impact some you've already filed. So hey, we have all of that stuff. So let's talk about the bill in general. As I said, it's the American Rescue Plan Act of 2021. It was signed into law on March the 11th. It passed on a party line vote, very much like the Affordable Care Act. Well, Affordable Care Act was a little bit weird. It passed on a party line vote, but not via reconciliation. However, in the interim, there was a special election held in Massachusetts that required some interesting things to be done to settle the difference between the Senate and House versions of the bill. And in fact, they did use the reconciliation provision to make some of the changes they wanted to make between the Senate and House bill, but pretty much had to accept the Senate bill in certain areas because it wouldn't qualify for reconciliation. The reconciliation process was also used for the Tax Cuts and Jobs Act. It was attempted to be used for the repeal of the Affordable Care Act, but we all know how that crashed and burned early on back in 2017. So, keep that in mind. The reason you do this is you don't need 60 votes in the Senate in order to pass a reconciliation bill, but you only have one of them per year. In theory, this burns up one of the two the Democrats can use. Obviously, the Democrats have one more they can play when they get to the point of doing, quote, the next budget year. They can run through the reconciliation bill at that point. In the reconciliation process, tag a bill for that. Again, it has weird rules based on the Byrd rule, what's in there, but expect at least one more reconciliation bill to come up, and we'll see what's in that one. This particular bill has mainly 1 to 2 year changes. Lots of this does not go on any longer than that, but there are a few permanent provisions that are in there, so be aware of it. And as I said, we're looking at a quick summary. This is not in any way, shape, or form a deep dive. In fact, what I'm going to post on the website is going to be just a copy of the slides I'm using for those of you watching on the video site that we're using in today's session, just to give you an idea of what's there in summary. But it is far from a deep dive. Again, that's going to be in the courses we'll be doing. I'm going to spend a couple of hours, and even at 2 hours, I think it's going to be tight, but it's going to be better than what we can do here today. This will be a quick summary. Okay, unemployment compensation was the thing that got everybody's attention right away, and that's because it's going to affect these returns. It is a maximum of $10,200 of unemployment compensation per person. So that means if you have a married couple filing a joint return, it is a per spouse basis, so it's not as if you could exclude $20,400 all received by one spouse if someone got that much, but rather it is each spouse. So you'd have to have each spouse receiving unemployment. If they each received at least $10,200, then in theory we could be excluding up to $20,400 from their income. But it only works, and you only get this if your modified adjusted gross income, as required by this provision, is less than $150,000. So that means that $149,999 computing modified AGI, and we'll talk briefly about what that modification is. If you're at $149,999, you can exclude the $20,800. If you are at $150,000, that entire $20,800 will come into income immediately. So that'll produce some insane marginal rates at the very edge. So be aware of that. One thing I'll warn you is, obviously, if a client in that position could do something like make a deductible IRA contribution, that might be the perfect thing to do in order to bring the income just down enough, adjusted gross income down just enough to qualify for the full exclusion. So they might find the decrease in tax would more than pay for whatever they're putting in the IRA. So be aware of that. Now, the modified AGI, as I said, pretty much it's everything. This is like the last thing to be computed. So what you do is you first compute your return, adding this into AGI, adding the unemployment into AGI, compute all of your limitations based on that, and then go back and see, are we above 150? Or are we at 150 or above? If we are, then you have to include this in income. If we're below, you can keep it out of income. Now, it is a cliff provision. It is all taxable once we hit $150,000 of modified AGI. Other interesting thing to note, the law says nothing about filing status. So it appears that married separate and married joint each get $150. That opens up some obvious planning issues. We'll have to see how that works. We also have the weird part about in a community property state, and there the issue is going to be, while I can certainly split things perfectly, since I'm going to end up with only half of my unemployment on my return, I could exclude that, but can my spouse exclude the half of the unemployment that goes onto my spouse's return when it wasn't hers? And that's not really clear from the law as to how that would work. So not sure how it's going to work in a non-community property state. Obviously, if we could file separate and bring at least one spouse, or at least the spouse has got unemployment below the 150 limit, it appears that would get that out of income. The problem there is if you have radically different income, your bracket problems with married filing separate will claw back some of the savings from excluding the up to $10,000. So it could be a complicated way of reporting. The IRS has already published changes to the instructions to lines 7 and 8 of Schedule 1 of Form 1040. Line 7 is unemployment compensation. Line 8 is other. Basically, they have told you if a return has not yet been filed that has this, we're going to report the unemployment compensation on line 7 just like usual. But on line 8, we will have a negative number to subtract it out, and we will put a unemployment compensation. I believe it's UCE. Unemployment compensation exclusion is what I believe that's going to stand for. That'll go on there with a negative. Now, your tax software will probably be updated to do that automatically, make the calculations. Obviously, you could force it right now. In theory, it should work. The problem I have with doing that is once your tax software updates, it's going to be very easy to double calculate that exclusion, and that could become a problem if your client is like some of my clients and they get the return and then they just keep holding it until right before April 15th, call in and say, oh, I've got this change. You make the change and don't notice that you're now double subtracting the unemployment. If you do that, remember, because they call in the day before the 15th and they need it right now. And of course, they don't go on extension because obviously they'll be thrown in jail if you do that. So, yeah, watch out for that. I would probably wait for your software to actually support this before I would go ahead and try to get this going. Next up, we have the Recovery Rebate, the 2021 edition, our third pass at payments to taxpayers. This one will be $1,400 per person. So a married couple filing joint return will get $2,800. We also get $1,400 for every dependent. It is not just qualifying children. So every dependent we have, so college students will count for you. This will be the first one that the college students will actually be able to get the credit. Mom and dad will get the credit for the college student. Okay. Now it has a phase out. It is exactly the same trigger levels as before for phasing out. So bottom line, we begin to phase this thing out essentially at incomes of $75,000 for single taxpayer, $150,000 for married filing joint, and $112,500 for head of household. But unlike the last two credits that phased out based on a spread that really depended upon how much of a rebate you were getting, so the more dependents, the longer it took for it to phase out. In this case, it will phase out entirely over $5,000 if you are a single individual or married filing separate, $7,500 if you are head of household, $10,000 if married joint. That is way quicker. Previously, for a married couple with no dependents, at the original one last year, it took you essentially, remember my numbers here, I believe it took us $40,000 of additional income beyond our 150 limit to phase it out. That's going to phase out over 10 grand only. And again, and previously, if you had like 3 or 4 dependents, that would also stretch out much longer your phase out range. If you had dependents that qualified you for the credit, that will no longer do it at 10 grand above. So once you get to $160,000 as a married couple, you've lost the credit. The credit is gone for good. You won't qualify for the advance payment. You will not qualify for the credit on the 21 return. Now, interesting calculation. As before, the IRS is going to calculate this. And the law says they base it on the 19 return, which is a little bit reverse from last year, but they will do it on the 2020 return if the 2020 return has been processed by the IRS. Now, be careful reading the law. The law says if the return was filed before the date they compute the credit to pay, the amount to pay you. But then later on they say, well, but nothing counts as filed until the IRS has processed it. So realistically, it's got to be processed. And that means if a client tries to file a paper return, it's likely not going to be processed before they issue the original check. Now, there is a fix, though, for this of sorts, but it's not going to help that paper filer probably. If they do pay it based on the 19 return and the taxpayer files or the 2020 return gets not necessarily filed but gets processed before the one of two dates, the earlier of one of two dates, then they will, and the 2020 return will result in a higher payment than the 19 return would have. They are going to issue another payment for the difference. Now, that phase out date is weird. Okay, we'll talk about that particular phase out date. Or I should say date you have to have it processed by. So again, remember, since it has to be processed by the IRS, we don't know the actual date we have to get it in by. Even once we set this processing date, you're going to have to give some lead time as to how long it will take the IRS to process a return. And obviously, a paper return will take way longer to process. The returns, the cutoff date will be normally 90 days after, let's say 90 days after the regular due date for filing the 1040 for the calendar year. So you would say July 15th. But a special provision of the law says if the IRS were to use 7508 Cap A again, Treasury was to use that like they did last year to extend the April filing date, that's going to move this as well. Now, since they don't want that to continue forever, they have a second limitation that says if September 1st comes up before the 90 days after the filing date, then September 1st will be the processing date that'll be used for this purpose. Meaning, effectively, if they kick back the date more than a month, so if they were to kick back the date to June 15th, let's say, then 90 days from that would be September 15th, so September 1st would take over. If they only gave us an extra month, so they said it would be May 15th as your filing date, then what would happen is then at that point, it would be August 15th would become the processing date. So be aware of that little rule. And again, we reconcile just like we did this year, but we're going to reconcile on the 21 return. So we do not need to know the amount they're being paid, and the payments are going out right now. We don't need to know how much that is before we can finish their 20 return. Minor favors. We also have a new prepaid child tax credit for 2021. The child tax credit, generally, the base amount of it, is going to be increased to $3,000 per qualifying child. And qualifying child will include children who are 17. So we do get them all the way up to 17. So until they're an adult, basically until they're 18, it will count. This is for 2021. If the child is under age 6 at the end of 21, it'll be a $3,600 credit. So basically 5-year-olds and below qualify for the $3,600 credit, but they've got to be age 5 on December 31st, age 5 or less on December 31st of 2021. If they've made their 6th birthday by then, it's a $3,000 credit, not $3,600. It is phased out weirdly in two separate calculations, and this gets to be a little bit interesting the way the phase out comes in this case. The first phase out comes at a much lower level, right? So we have a first phase out for the extra they're adding. This is at a much lower level, more in line with what we had before the Tax Cuts and Jobs Act, right? So we have a phase out that comes in much, much earlier that begins to phase this out of the taxpayer's income. So we begin this phase out. Once we have done the first phase out, and there are ways it's limited, so the first phase out kind of stops after they have phased out what's effectively been the increase. Once they have stopped that, Then we have to go back and check to see if we need any phase out based on the Tax Cuts and Jobs Act limitation numbers. So we have to do the TCJA phase out. So it's a 2-pass phase out for the child tax credit, meaning the computations get tedious. I wouldn't say they're difficult for those of us who work with tax to figure out. They probably are going to be very confusing to those that don't work with tax. So don't be surprised to get a lot of clients calling asking, well, am I getting this and how much am I getting and is this right? So like it or not, you're probably going to have to figure this out. And why they're going to call is they're going to start sending taxpayers monthly checks based on the amount of child tax credit they believe they will qualify for based on their 2019 or if they filed 2020 in time, the 2020 return. As they file 2020 later in the year, the IRS will update. And if they figured out you've overpaid or you're likely to be getting a larger or a smaller child tax credit based on that, they'll adjust the last few payments one way or the other. It will be, as I said, it begins paying out in theory in July. It may get delayed, so we have a little work there. They did say Congress ordered them not to work on this until they've gotten the regular payments out. So they're not going to delay for this. They're not delaying for this. So probably it'll be July. On your 2021 return, you will reconcile. So you have to reconcile this, and you may have to pay back if one half what they thought you were going to get is more than what you actually got. So it means really we're off pretty significantly. You have to pay back the difference. Most likely that'll occur because you don't have any kids, any dependent kids on the return this year for whatever reason. Because of that, the IRS is ordered to provide a portal that will allow people to go online and say something like, hey, I won't have any qualifying children this year. So you need to take that off, take that off there. Or they also can just say, I don't want to take the risk of being overpaid, so don't do that. I'll take my credit on the return. Or you can update and say, hey, wait, we had a child born this year, so we're going to qualify for an extra $3,600. So all of those updates are supposed to be done via a web portal. The IRS is supposed to run out on this. So clients will have to be aware of that coming down the path as well. We also have a few changes in the earned income tax credit. These basically expand the earned income tax credit in certain ways. The first thing is there's going to be an expansion if you have no qualifying children. We're going to previously, if you had no qualifying children, you had to have attained age 25 by year end, but not have attained age 65 by the end of the year. Well, first thing is we're going to drop the minimum wage to what's one of three ages. Age 24 if you are a qualified specified student. That's going to mean your average college student will be a specified student. So yeah, we're not going to let them in during their college years to get earned income credit for the most part. So for them, it will just drop it for a year from 25 to 24. Age 18 if you're a qualified former foster youth or a qualified homeless youth. So you're one of these youths who was actually in foster care after age 14, or you are considered under the rules they specify to be at risk of being homeless or are homeless. You qualify for it even though you are age 18. And then age 19 for everybody who's not in one of the first two categories. They're also going to, for 2021, that's for 21 only, they're going to also take away the top end limit here. So the age 65 rule won't be there either. So now somebody who's age 80 or 90 could qualify for the earned income credit next year. If they have, a minor amount of earned income, not significant income, they could qualify for that as well next year. They also are going to increase the credit for these people. They make various changes to the tables used for computation that will generally serve to increase that credit. They got rid of a law that used to say an individual who had one or more qualifying children with EIC with that, if no qualifying child, the individual is taken into account due to a failure to provide an identification number. They didn't have ID numbers for the kids and provide ID numbers for the kids. They would bar them from getting the credit entirely. That bar is now gone. They'll just lose the kids they don't have ID numbers for. We also have certain cases where separated spouses can qualify for the earned income credit. General rule there is it's got to be married, not file a joint return, has a qualifying child for more than one half the taxable year, or has a last 6 months of the year, does not share the same place of abode as the spouse, or has a decree, instrument, or agreement other than a decree of divorce with respect to their spouse, and is not a member of the same household as of the end of the year. And that rule is borrowed actually from 121, the sale of residence rule, which is a bit weird, but that's where we'll get it. They're also going to greatly increase the amount of investment income you can have and still get earned income credit. We're actually going to jump that number from 2,200 to 10,000. To do that, modify the inflation adjustment. But that means a much more significant amount of unearned income essentially can be earned by somebody and they can still get the earned income credit. Right? That'll be there. Also on the 2021 return, or 2021 return. Yeah, I think I've got it wrong on my slide, but I should have it right on the, we'll talk about it here. You're going to be able to use 2019's earned income instead of 21's. It's not 2020 the way the slide shows. It's going to be 21. So the idea is it doesn't affect 20's return because you already had that option for 20. But rather, you're going to be able to use your 2019 earned income again. And remember, whether you want to or not really kind of depends because, for a while, more earned income helps you with the earned income tax credit, then it starts hurting you. So, yeah, we're going to see how far, you got to figure out which one's the better year based on your particular situation. Dependent care assistance gets a lot more generous unless you make too much money. So what's going to happen here? Our dependent care credit, we're going to jump that number. Used to be that it was $3,000 for one qualifying child, or individual, $6,000 for more than one. That's going to jump to $8,000 and $16,000. As well, the credit will go from starting at 35% to starting at 50%. And the phase out, remember it began to phase down previously at $15,000, that 35% began dropping essentially over a time period. So it dropped by 1%, but not below 20% for each $2,000 or fraction thereof that your adjusted gross income exceeded $15,000. So once your adjusted gross income exceeded basically $45,000, you were at 20%. Now that phase down will not start until adjusted gross income goes in excess of $150,000. That means a lot more people will qualify for the major benefit. And again, now we're going to be looking at going from 50 down to 20. That'll be our first stop point. That's going to give us 30,000, which means I need about 60,000, or basically 58,001 extra dollars above the 150. So 208,001 and $1 in AGI before I get myself all the way back down to 20%. Now, interesting enough, while it stops at 20 for a while, it'll start running again at $400,000 of adjusted gross income. And that will then eventually phase all the way down to zero. So if you have a client that has $500,000 of adjusted gross income, for 2021, they will not get a dependent care credit because they're going to be at the totally phased down level. And at that point, it goes away. It applies for 21 only, this special dependent care, at least for now. And I think a lot of this has to be at least for now. A lot of this has been written to be codified in the law that allows them to start arguing for an extender and putting some or all of these into a year-end extension package. So don't be surprised if every one of these comes up as an extender this year. As Representative Neal was quoted as saying this week, it's much tougher to put something in the code than to take it out. So they are using this, this chance they have to take things that previously had been put outside the code and was just in the special COVID relief bill. They're moving them into the code itself. That sets them up for an argument they should be included in extender packages. So yeah, watch, some of these things may have a life beyond the life we're told. We have the payroll tax credits. Hey, they're back again too. And this one, the sick pay and family leave credits. Let's talk about the sick pay credit. These apply to the second and third quarter only. Okay. of this year. So the first quarter sick leave is what's based on the law that was part of the comprehensive, appropriations, right? Comprehensive Appropriations Act of 2021 that was passed and signed into law on December 27th. This one is now going to start on April 1st. This will apply for the second and third quarter. Again, no mandate to offer the leave. So that's going to be a nice thing, I guess. It will add 2 new reasons to remember. We had 6 potential classes of reasons why you'd get the sick pay. And if you offer the pay as an employer, you may be reimbursed at up to $511 per day if you're in the first 3 categories, which apply generally to the employee themselves, and at up to $200 per day if they're in the last 3 categories. We are going to add 2 brand new categories to that 511 number, right? Up to 5 days of leave at $511 per day for the reimbursement. And that is one of the ways we're adding is going to be if the employee is obtaining COVID testing. And previously you had to have, basically it had to be looking for the diagnosis because you had symptoms. Now they're going to expand it and say if you're being tested because you were exposed to COVID or because your employer is requesting it. For instance, maybe, you want to be able to tell your customers that, we have our staff tested weekly for COVID. Let's say that was one of the things you're going to do to try to sell people on coming into your business. We test everybody every week for COVID, which really doesn't sound fun given how the thorough COVID test is done. We'll just say that sounds rather painful. I'm not sure the employees are going to like that theory. But if you're doing it, we will let you pay the employees and reimburse you up to $500 per day or $211. And we're going to discover that that's going to go way beyond 10 days. We'll get to that here shortly. The second way, which makes lots of sense, except for the fact it doesn't start till April 1st, is if you're paying people who are taking leave time to obtain a vaccine or who have some sort of reaction and end up having treatment as a consequence of the vaccine. If they have some sort of reaction that causes them to miss work, then that also can be reimbursed. Again, this does not count until April 1st. So you want to be careful. Don't jump the gun on this one. Now, you're not required to provide this leave. So, again, it's not mandatory. But if you do and you want to get reimbursed, you have to meet non-discrimination rules that, for all practical purposes, require you to offer this leave to every single employee you have, full-time, part-time. You cannot come up with a classification. Well, let's put it this way. You can't have a discrimination based on highly compensated. Well, that'd be expected. You also can't have it based on full-time status. So you can't exclude part-timers. You can't base it on their tenure with you. You can't base it on how long they've worked with you. So you might be able to base it on a geographic area, right? You might be able to base it on some other criteria, but you cannot base it on anything that results in discrimination based on those issues. And I would say that may also be if geographically you know that you have all full-time employees, let's say in your office in Phoenix, but you have all part-time employees in your office in Prescott. You couldn't exclude the Prescott people and allow the Phoenix people to go. I think that would also be, if the practical effect was to discriminate in favor of the full-timers, that could be a problem. So be aware of that. Pretty much going to say, you really want to make this safe, you're going to have to offer to everybody if you do it. And they make it clear the credits to be included in the taxable income of the employer. And they're solving a problem we've had that's still not really solved for the employee retention credit otherwise, but they did solve it here. It's going to be included in taxable income of the employer, essentially, for the year, basically in which the quarter ends. So it will be. So if you file a claim for refund later, you'd have to go back and amend the tax return for the year in question. You couldn't amend and then say, I'll pick it up and later you're going to get the money. Even cash basis, you're going to be required to pick it up back in the year that basically it applies to. That was kind of interesting. It did that. Family leave is very similar to sick pay in the prior family leave rules, but we now get 12 weeks. So the first 10 days are not unpaid under this rule. And those final 2 qualifications apply here as well. So that means for the vaccination and for the testing, we really have, in this case, not 10 days, involved, or what's basically two full weeks of pay. We have up to 14 full weeks of pay. So now that's based on days. So you have to expand that up based on number of days. But essentially, we're going to have 70 days that you could have for testing, vaccines, etc. You could provide leave up to that. So if you were doing a lot of testing, this could provide a way to offer it as paid, which may very well have to, because I'm sure Department of Labor would say, wait, if these people are required to get tested, then that means that, if you're requiring to get tested, that's work time and you should be paying them the rate. So obviously this would be a way to get that subsidized. Seems like that's kind of what they're going for here. We also have a change employee retention credit for the second quarter, for basically the second half of 2021. We've got making some slight modifications to the employee retention credit we have for the first half of the year. We discussed last week. It does run for the third and fourth quarters of 21. So this takes effect July 1st after the current ERC goes away. It adds one new class of covered employers and allows some large employers to get the credit on all employees during the distress period. If you are looking at the slides in this, either on your screen or you downloaded the PDF, I have there the summary based on this that's similar to the summaries you used last week. In this case, again, we have the distress period, covered wages, and how you claim the credit. Well, the distress period now, when you're allowed to claim it, you have to be in the distress period. And it's the same too as before. Your receipts are down by over 20% over the same quarter in 19. You have a period of full or partial suspension due to government order based on that. Or number 3, you are a recovery startup business. Now, recovery startup business is somebody who started in business after February 15th of 2020. Now, the good news is you will always qualify because you'll at least be a recovery startup business. You could meet the other classifications because there is a rule now that lets us look at comparing a quarter. If we weren't in business in the quarter in 19, we compare to a quarter in 20. So we could still qualify based on drop-in revenue. Easier might be qualifying based on a government order that might apply. If you saw things, we're hoping it doesn't happen. But if things began to go here like they did in Europe, they have in Europe, where it may be more based on the problems they've been having with the vaccination programs over there. But if that did, then in theory, this could trigger it there. If you fall into those categories, you don't have a limitation involved. The limitation, if you are a recovery startup business, is you can't have any more than $50,000 in total credit in a quarter. That's the takeaway, even after applying the $10,000 per employee. Once you get past employee number 7 in the quarter that has 10 grand, you're going to get above 50 grand. So, yeah, they're going to stop you there. It's a per employee. Again, the basic rule doesn't change for covered wages and what's going to count, except if you are a large employer with more than 500 employees. Remember, previously you only got a credit for paying people that weren't currently doing work. Now that's going to be changed. So you could get credit for everybody if you're a large employer, if you are a severely financially impacted employer. But what that rule says is it's not your revenues drop 20%, your revenues are down more than 90% from what they were in the same quarter in 19. That would be somebody who essentially shuttered, right? They've shuttered the business for the most part. So you could be something like a lot of movie theaters, various live venues could be there. Now there are rules in all of these that don't allow you to use wages to count for both to qualification under shuttered venue wages, and also meet them here. You can't double dip. That is part of all of this. So we do have our double dipping issue that's there. But we do have that option. Otherwise, it's pretty much the same, including the advance payment is there for the employee retention credit for the last 6 months of the year. That will complicate how you're going to determine, if you're trying to maximize your ERC and get your PPP loan forgiven, it's going to complicate that. We also have some significant premium tax credit expansion and relief. For 2021 and 2022, effectively all taxpayers will become at least potentially eligible for the credit. If the second lowest cost silver plan that's available to you in your area is, ask for a premium that is more than 8.5% of household income, you're allowed to essentially get a credit for that excess over the 8.5%. So what we're saying is we're going to guarantee that everybody can buy at least the second lowest cost silver plan in their area for 8.5% of their household income. There's no longer this limitation that stops the credit when you have 400% of the poverty level. Go above that level, you can still qualify for the credit in 21 and 22. Big thing that will affect already filed returns. You're not required to repay an excess advance if we compute that for 20. Now, again, the IRS is saying, please don't send amended returns yet, right? But obviously, there are some people that have paid that excess. And the problem is, how do you stop it? What's even worse is they haven't yet paid the excess, but they have it automated. So on April 15th, they're going to pay that excess. Oh, yeah. I do not know how the IRS plans to fix that little problem. We will just have to wait and see, or if it can be fixed. Also, there will be special relief if you receive unemployment in 2021. For most purposes, your household income will be considered at 133% of the poverty level. The exceptions will be primarily for testing to see if you had an affordable offer of coverage during the period you're employed. That will look at real household income, not your actual income, or this deemed 133% of income, I should say. That'll look at that from that standpoint. We also have an exclusion from income for certain cancellation of student loan debts for 2021 through 2025. And yes, there's a lot of speculation that this sets up a more generic cancellation of student debt. So you should be aware of that out there, that's out there. So, keep your eye on that. But it expands Section 108F5 to remove from income cancellation of most student debts. And it's a really broad range of loans you can read in the law. There's a lot of things covered. It's going to cover most student loans. The kind of federally guaranteed student loans will be covered under this program. Now, the catch is, though, there is a anti-abuse provision that is involved for loans that were given for services. We can't claim those. Oh, we can't claim that money. I gave you that for I gave you a loan for services you gave me, right, that you used to pay for tuition. You can't go around and say, oh, guess what? We're gonna waive that. Nah, that's not going to do it. If it's for services, either they pay back the loan or they treat it as wages because, yeah, we're not going to open up that can of worms. So as I said, the law's there. There are other parts of the law, certainly, and a lot more details in the areas I just talked about. So you should be sure to take a look at things. I will be teaching a session. Like I said, I got sessions for Arizona and Idaho this week. You want to check there and see what's going on to sign up for those. And also the session coming up in the following week for the New Jersey Society of CPAs. That one is going to be a bit longer, may get a little more detail. But the problem is you're trading time and it's later in tax season. So, yeah, we know how that works. This is not the best time thing. Apparently, I'm kind of hoping by the time we get there, if the IRS is going to extend tax season, they will have done it by then, which means that people will feel better about signing up for a slightly longer course. We'll see where that goes. My guess was if they're going to extend tax season, I was sure they would never do that prior to March 15th. And basically they haven't. So everybody's got their extensions together for their flow through entities. So all that's been done. Now they're to the point where they could go ahead and extend the April date if they wanted to. We'll see if they decide to do it or if they decide to try to just keep pushing through. Certainly this week we had the Chair of Ways and Means who also came out in favor of extending. That's a major change in structure, major change in who's calling for it. We'll see if that takes them there or not, or if they're really going to just try to keep it and say, hey, the due date's coming up. But in any event, this has been the current federal tax developments for the week, the new tax law. If you have any questions or issues, Ed Zollers at currentfortaxdevelopments.com is my email address for contact. I also do try to check in on the Connect sites for Arizona, New Jersey, Illinois, Washington. Keep my eyes on those and see what's happening. We'll also be back here next week for whatever else may come. I'm sure we may have a little bit more guidance on the things that are in this bill. Maybe we'll know if the IRS is going to automatically compute a refund for People with the unemployment, are they going to automatically refund those people that have paid back their premium tax credit advance? Or are we going to have to amend? Hopefully we can find that stuff out, as well as other things. So keep your eye there. We'll be talking about that. Otherwise, hopefully you're going to have gotten through your extensions for your pass-throughs, because that's what came up on the first day of this week. And we're heading now into the home stretch. It'll be 1 month until April 15th and maybe the due date. Again, we still got to say maybe because who knows, might push it back again. But the maybe due date. In any event, check back in here next week when we'll talk to you about more things that have happened in current federal tax developments.